So I'm going to talk about, not going to talk about the global financial warriors episode in my life, which was unbelievable because it was 9/11 and trying how to respond to that on the economic front. But that's well behind us right now. We've got another crisis to be worrying about, and that's what I want to talk about, is the crisis that we're in. And it's been the subject of my own research for the last couple of years, actually since before the crisis began. So that's what I want to talk about, and maybe just to give you sort of how this book, which is on the screen here, that's the cover, Getting Off Track, and how the name came, what the name has to do with, and how I got involved in this project, which is it's a small book. It's meant purposely so someone can sit down and read it and get a perspective on the whole crisis. Last November, after the panic of October and September, I sat down and said, well, what does my research over the last 2 years tell me about this whole crisis? You know, what went wrong, if you like? And I wasn't aiming to find any particular one cause. In fact, in economics, it's, I guess, any subject, it's rare you can find one cause that everyone agrees with, and that's the case here. There's no question we'll be debating this issue for many years into the future. Some of the most definitive works about the Great Depression were written 30 years after the Great Depression. Milton Friedman and Anna Schwartz wrote their history of monetary history of the U.S. economy and published it in 1963. So it's influenced a lot of people, but 30 years later. And another popular book about the Great Depression by Amity Schleys, The Forgotten Man, is just written, I guess, last year. So here, this is a book that's written about this crisis in the middle of it, if you like. And the reason for me wanting to do that is it seems to me that, first, I've been working on it, but we have an opportunity perhaps to learn about where we should be going now from trying to better understand what happened. And so what went wrong is an important issue to discuss, and I actually wish there was more of this, really trying to put forth a coherent picture of the whole thing. Okay, so to divide this question into some more understandable parts, because what went wrong is such a big question, I thought about, well, maybe you could think of 3 different aspects of the crisis and then analyze each of those separately. So I divided what went wrong into these 3 questions. First, what caused the crisis? Second, what has prolonged it for so long? It first flared up in August of 2007 and has continued for much longer than many had expected. And third, why did it get so much worse last fall in September and October, which is simply like a panic? And I'm writing from the perspective of November of last year, so this is pretty much through the panic, and we're going to talk about, I hope, in the questions and answers about what's happened since November. But to me, that's a logical place to stop this and ask, stop if you like, and ask what happened. Okay? The interesting thing, and I hope you can see my point as I go through, the interesting thing about this, that's the reason for the title, is that in each of these questions I found that certain government actions and interventions were the answer. They came to the top of the list of many, many possible reasons. And I don't want to say they're the only reasons, but they seem to me to be the most significant. And that's not a story you hear very often, quite frankly. You certainly don't hear it from governments, which is a case of natural, I guess. And so in some sense, maybe the role of people like me, like you, in civil society is to see if this is really something that will hold water. But you won't hear this very much. Hopefully you'll hear more of it over time, because I think it's correct and important to understand. So that's the reason for the subtitle, How Government Actions and Interventions Caused, Prolonged, and Worsened the Financial Crisis. Okay, so let's first begin about the causes. Actually, financial crises, as a rule, if you like, have been caused by some kind of excesses, which then lead to booms and busts and collapses. And this crisis, in some sense, is no different, I think. It began with some excesses, actually monetary excesses, and monetary excesses are not unusual as ways that booms get started and end in busts, but this one is very much the same. And to illustrate, I want to use this policy rule that John referred to in his introduction, the so-called Taylor rule. It's actually, I wish it weren't called the Taylor rule, quite frankly, because it makes my analysis a little less objective sounding. I wish it was the Smith rule or the Williams rule or whatever, but it's the Taylor rule, unfortunately, so I have to pretend I'm objective, if you like, or try to convince you it's objective. One way I can do that is by taking my first graph, and this is basically a series of 16 graphs, and they're in my book. I always say, picture's worth 1,000 words. We had 16,000 extra words because of this. And this is the first one. But to illustrate this idea that it's be better if it were called something else, I chose the first chart in the book right out of The Economist magazine. So if you read The Economist very often, you'll see that this chart looks like an Economist magazine chart. It has the same kind of font and lines, and it even has the joke title, in this case, loose fitting, okay? So what do you see in this chart are two things. One, the light blue line is the actual settings of the interest rate by the Federal Reserve from 2000 to the end of 2006. That's the span of time on the horizontal axis. And the blue line shows that that interest rate got to about 6.5% in 2000. The Fed was tightening. We go into a downturn. The economy weakens and the Fed cuts interest rates. And then it gets down to 1% and holds it at 1% for a while and then raises it rather slowly until it gets to 5.25%. The dark line is what the Taylor rule would say should have been done. And there's a part where the blue line and the black line overlap, so you can't see the black line, it's underneath. And roughly speaking, that's when the actual policy and the Taylor rule were on the same track. And so the off track, if you like, begins closer to 2002. And it's really not very much in 2002. The biggest distance between the blue line and the black line in this chart looks like it's towards the middle of 2004. And then they start to close a little bit. So what is the Taylor rule? Well, best way to think about it is simply a description of what the interest rate should be depending on the inflation rate and depending on the overall state of the economy, how real GDP is performing compared to its potential. And it says that central banks, the Fed included, should raise interest rates by a certain amount when inflation rises, and they should cut interest rates by a certain amount when GDP falls, as in a recession, as we're in now. The important thing about it is it gives the magnitudes by which the interest rate should be increased or decreased in those circumstances. It says, for example, that the interest rate should rise by 1.5 times the inflation rate. And it says the interest rate should fall by 0.5 times the percentage decline in GDP. So those numerical things are important, otherwise it would just be something that couldn't be used in practice at all. Okay, so the thing that's perhaps more important, about this picture than the Taylor rule concept itself is the Taylor rule actually describes policy pretty well in the 1980s and the 1990s. In other words, if you looked at a plot of the interest rates and this policy rule, it would look very close, certainly much closer than this. Okay, so what I say is that whether you think of a Taylor rule or another rule that's similar or some empirical description of how Federal Reserve has set interest rates in the 80s and 90s, by the way, a very good period, long expansion, short recessions, then you would use this, that you would say they should be following the black line. So the black line says what the Fed would have done had it followed the same kinds of procedures it followed in the 80s and 90s during this period. So it got off track, if you like, one example of getting off track compared to what it would have done. So to me, this is now a measure of monetary excesses. You talk about those monetary excesses that got this going. This is a measure. Interest rates were too low, 1% for a long time, to compare what they otherwise would be. And you can use other methods to do this. People have computed this in different ways, and we can debate it, but this is what this formula tells you. So number one, monetary excesses, the economist calls it loose fitting, and loose, of course, a play on words for loose monetary policy. And that's what you get. Now, to be completely candid, The Economist lifted this chart from some of my work, so it's not completely like I'm pulling it from The Economist de novo. Now, from a perspective of economics, I don't think it's enough to just say they were off track and say, therefore, you had a housing boom. It makes sense, perhaps, that low interest rates would cause a housing boom, be easier to get mortgages, low interest rates on mortgages, et cetera. But it seems to me that you also have to go further than that and try to ask the question, would there have been a housing boom and bust had the Federal Reserve followed the policies it used in the 80s and 90s, i.e. the dark line, the dark blue line or black line. And to do that, I built a model of the relationship between the interest rates and housing starts. That's what I focused on. And then I tried to compare the actual housing start numbers with a counterfactual that if the Fed had followed this particular policy. Okay, so this is the picture I came up with. It's the same span of time as the two interest rates, 2000, 2006. And in the graph, the jagged red line is actual housing starts in the United States. And you obviously can see this boom in the 2001, 2, then it really gets going in 2004 or 5, reaches a peak in early 2006, and then we have the bust. And of course, the bust is continuing. This only goes through early 2007, but it may be down about my head right now if you continued the line. That's what actually happened. So then the counterfactual is say, well, if the interest rate had been higher, like the policy, well, what would have happened to the housing starts? And that's what the blue line tells you. So you put in this little model, an alternative interest rate, and the alternative interest rate is given by the policy rule, and you get, of course, much less of a boom. In fact, you don't really get a boom at all. You get a sort of a modest swing, and then it comes back to where it is now, and you therefore avoid this huge bust. Okay, so this is my, if you like, more substantive evidence that monetary excesses cause this. And you can, again, think of it as very low interest rates, 1%. It's enabled to have mortgages with very low teaser rates. It makes buying houses much cheaper, mortgages are much cheaper, and therefore plausibly affecting this. And based on the model, empirically estimated over many, many years, not just this period, it seems to be plausible. Okay? So that's really, if you like, why I think the monetary excesses are the cause of the boom and the bust. Now, not everybody agrees with my theory. One person who has challenged it in public quite a bit is the former chairman of the Fed, Alan Greenspan. He was in charge at the time, so you could think that he might have a few things to say about this, and he's a good friend, and the best thing you can do is have good debates, and that's why I'm trying to put this thing across in the clearest way possible. But one of the alternative explanations is that there was a global savings glut during this period, which drove interest rates down. High savings drove interest rates down, and so there's nothing that the Federal Reserve could have done to prevent that, even if it had raised interest rates. And so raising interest rates, you normally think will affect not only the short rates which are being raised, but also longer-term rates. Mortgage rates would have a general increase throughout the whole term structure. Well, in this case, if there was a global savings glut, you'd see might see interest rates lower no matter what, especially longer-term interest rates. So this chart was put together by the IMF in 2005, and I include that in my presentation because if you look at the blue line, that's the global savings rate, saving as a percentage of GDP in the whole economy. And you can see there's no sense in which this is a glut. At least just looking at the rates, savings rates globally are low. There's investment rates are very close. They should be the same, but there's a little measurement error. But basically moving very close to the saving rate. So it seems to me there's almost prima facie, you look at this and you say, well, how can there be a global savings glut? And therefore, I reject that explanation. Now, of course, there's more sophisticated ways to think about this, and that is to say, well, while there was a global savings were low, that was largely because the U.S. was not saving very much. And in fact, savings outside the United States was high, and that is indeed true. During this period, in fact, for a long period in the U.S., you've had low savings rate in the U.S. and high savings rates abroad, and that's led to the current account deficit that we've had. But that doesn't lead to lower interest rates in a global economy because the interest rate is a global interest rate. So I think it's this overall rate is what to look at. Another thing that's been raised about this explanation is that, well, you're talking about the United States, but there were housing booms in other countries. There was a housing boom in Spain, a housing boom in Ireland and UK. What about those countries? Well, what's amazing to me is that since I first started working on this in 2007, other people have done similar work in other countries. And the most interesting to me is work done by the OECD. And this is an example of their work. So they say, well, let's look at monetary excesses in a bunch of other countries and to see if they were related to housing booms in other countries. So they looked at bunches of countries. These are the countries within the European Monetary Union. And so there are deviations of their interest rates from the Taylor rule because inflation and GDP in those countries are not all the same, even though the interest rate is the same. So you get the same concept of deviation. So what this chart shows, if you graph on the horizontal axis the discrepancies between the actual interest rate and their own Taylor rules as computed by the OECD, and then on the vertical axis you put the change in housing investment as a share of GDP. So that's the housing boom. It's like my housing starts in the other picture. You see this amazing positive correlation where Ireland is up at the top, Germany and Austria down at the other side, and a very close correlation between these monetary excesses and the housing booms in this period. So it's really not right to say that this is only a US phenomenon. There's also the same kinds of things occurred in other countries. Booms and these excesses seem to be closely related. Okay, so that's the boom. Now, let's get into a little bit more about why interest rates may have been low set by central banks in more than one country at the same time. And one thing I think happens, it's more and more happening, is that central banks tend to follow each other a little bit. If the US has a lower interest rate, that will tend to make the other countries have slightly lower interest rates. And higher interest rates for the US will tend to have interest rates somewhat higher in other countries. It's an empirical tendency. I think we know some of the reasons is the countries are sometimes worried about their exchange rate appreciating or depreciating too much. So if the Federal Reserve has interest rates that are low, it will make, say, the European Central Bank a little wary about raising or keeping its interest rates the same because that will make the euro more attractive relative to the dollar and appreciate the euro. So they will tend, other things equal, to keep the interest rate low or not have it increase as much. You actually find that in the data. There is if you look at a European central bank policy rule and put in that equation the Federal Reserve target, the federal funds rate, you'll see a positive relationship. And to illustrate that, I put that in this graph with the same sample period, 2000, 2006, but I'm now looking at the deviation of the European Central Bank's interest rate from its own policy rule, and so that's the blue line. It's not, I didn't try to smooth it out anyway, that's just the numbers you get. And so that says that as with the Fed, the interest rate was lower in this period than it would have been if it followed the policy rule. And then the important point about this, though, is that that deviation is explained, quote unquote, because it's just a correlation. It's explained by the Federal Reserve. So it's a tendency to keep that interest rate lower, and that's explained by the red line. You can see the deviation explained by the federal funds rate is almost the whole thing. So it could be very well that some of the reason why you saw interest rates too low in other countries was, again, not this global savings glut, because there wasn't one, but simply that the interest rate there was some relationships between the two. More work needs to be done on the reason for this, and I think I gave the best explanation, and that's exchange rates behavior. Okay, so now that's given all that, which I think I answered a lot of possible alternatives. Let me now think about how this relates to get closer to the financial crisis itself, because so far it's just the housing boom and bust. But what about the mortgage defaults and the foreclosures, and why so many mortgages were issued at what now appear to be rates that people couldn't pay and ultimately would lead to default? Well, part of the reason, of course, is the housing bust itself. When housing prices are declining, there's a tendency for more foreclosures. And that's illustrated by this picture. And by the way, I haven't really, for some reason, the graph is cut off on the axis. So those of you who pay attention to axes may be disappointed a little bit. But I guess you can see the 2 and the 4 and the 6, et cetera. Those are the percent. That's the percent either inflation, housing price inflation, or percent delinquency rates and foreclosure rates on adjustable rate subprime mortgages. And you can see a really marked negative relationship. So when housing price inflation got really going in the 2004 or 5 period, delinquency rates and foreclosure rates declined. And then when housing prices started to not increase so much, they moved up again. In this period, which like the other graphs, just go through 2006, early 2007, you see the decline in the inflation rate. Of course, now house prices are falling, so you're in negative inflation. So this line would probably not only hit me in the head, it'd be down on the ground at this point because it's falling quite rapidly. So, but the point here is that with this negative correlation, it's quite understandable that underwriters of mortgages might issue some mortgages to people they might not issue to them before because foreclosure rates and delinquency rates were so low during this period. So if you imagine a cross-section of data that an underwriter might want to use, they're going to look at what's the fraction of the population with certain characteristics, income levels, wealth levels, credit histories, credit scores. Look at the relationship between those numbers and foreclosure or delinquency rates is the better way to put it. They might say, hey, gee, delinquency rates on these adjustable subprime mortgages are only 5%. Foreclosure rates just down about 3%, very, very low. So this is okay, but of course they're being misled by this very high inflation rate in houses. And there's much more incentive for people to make the payments on their houses. If inflation is high, if your price of your house is rising very rapidly, there's a lot of incentive to take an extra job or maybe not eat out as much, make sure you get your payments going. But if housing prices are falling, then there's less incentive to do that, and that's effectively what the data are telling you. So the low interest rates, to the extent they caused the housing price boom and housing starts boom, they were part of the reasons, I think, why you had these mortgages being issued that you might not otherwise issue if you had not taken the housing price inflation into account. Okay, so that's what more to say about this is all still in the first question: what caused the crisis? And I want to mention a couple other things about that because, first of all, this is not the only government action that was involved in this. I think the most significant other one was the encouragement of Fannie Mae and Freddie Mac to purchase mortgage-backed securities based on mortgages which would otherwise be considered too risky. It was basically sort of, if you like, another aspect of government actions here that accentuated this as well. So I just want to put that out. It's not part of the empirical work, but it's something I think needs to be brought into account if you're thinking about the causes of the crisis. Okay, so that's the cause. The next question is, why did it last so long? Okay, well, first of all, let's look at the crisis itself, the crisis in the financial market. So far, we're just looking at housing. Well, this is, to me, the best picture, best illustration of the of the financial market crisis itself. Okay, so what does this show? This is a graph. It's just from the beginning of 2007 through the middle of 2008. So it goes actually to August 2008. So it doesn't go to the present. And remember that because I'm going to show you some other graphs that go through the panic period in the fall of 2008. This does not go that far. This is a graph of what I'm calling LIBOR minus OIS spread. So what does that mean? Well, LIBOR is the interest rate on loans between banks. It's Citibank lends to Deutsche Bank or to Bank of America for 3 months. They charge an interest rate, and LIBOR is a measure of that interest rate based on surveys. And LIBOR is, because it's a 3-month loan, the interest rate is going to depend on risk factors during the 3-month period. It's going to depend on what alternative ways to use the money are. And in particular, it's going to depend on what the federal funds rate is, the overnight rate is between these banks over that same period. So OIS, which is overnight index swap, is a measure of what the interest rate is going to be over the 3-month period of the LIBOR loan. There's a market in overnight index swaps, and it basically gives you a good measure of what people in the market think the federal funds rate will be. Again, that's the overnight interest rate that banks charge when they lend to each other. What that rate's going to be for the next 3 months on average over that period. So the difference between these two indicates the extra tension or problems in the interbank market. This rate here, this spread, if you like, you can call it a spread. That's what I call it in the picture. This spread for many, many years has been very low and stable. And you can see in this picture, it's about 0.1 percentage points. If you extended that graph over towards the exit sign, over on the other side of the room, it would look about the same. It's just very flat through that whole period. So this jump, this huge jump you're seeing, which begins on August 9th and 10th, 2007, is very unusual. And that's really the crisis, the first indication of crisis. Anybody paying attention to money markets sees that right away. Fed sees it right away and says, gee, what are we going to do about this? This is something we've never seen before. My first paper on this was written, we started working on it about this time, and decided to call our paper the Black Swan in the money markets because it was such an unusual event. We'd never seen anything like it before. As a scholar and a researcher, I thought it was an unbelievably fascinating thing to try to understand and work on. But it also had potential policy implications. In fact, the Federal Reserve and other central banks where this phenomenon happened were very interested in trying to bring that spread back down again. And one reason is that many mortgages are indexed, or any other loans are indexed to LIBOR. So if you have LIBOR going up relative to what the Fed is trying to do with the federal funds rate measured by the OIS itself, then you're going to have a less satisfactory financial stimulus than you otherwise would. So they wanted to bring that down. So bring it down for its own purposes, but also bring it down because it was really a measure of the turbulence in the money markets in the US mainly, and Europe as well. So what could cause something like this? Well, there were two alternative hypotheses. And by the way, my point here is that you need to have the right explanation for the phenomenon if you're going to follow the right policy to fix it. Sort of like, if you like to think of it in medicine, if you have a patient who comes in sick, you got to diagnose what the disease is before you know what treatment to apply. And if you diagnose it wrong, you might apply the wrong treatment, and you either might not do any good or you might make it worse. So diagnosing why this occurred is really important. Plus, it's fascinating, quite frankly. Two explanations for this circulated in the fall of 2007. One is that there was a shortage of liquidity, not enough money, so that was driving up these interest rates. Banks didn't have enough money to lend to each other, so that sort of created tightness in the markets. Another explanation was that there was an inherent increase in the risk of lending to banks during this period. So it was hard to believe back in September of 2007 why say Deutsche Bank would be somewhat reluctant to lend to Citibank. Now we say that and we don't really think of it as a question so much, but then it was a question to try to answer. And in my research at the time with John Williams, who's now director of research at the San Francisco Fed, we tried to come to answer this question. And we did a couple things. First, of course, most important is to interview people in the markets and try to figure out what they think. So a lot of interviews in and the major players, the traders in the markets, get their opinion, but also to try to use empirical analysis to do it. So on the empirical side, we tried to look for measures of risk in the banks. If you could define a measure of risk and see if that was correlated with this picture, you might say, oh, it's risk. Well, we did find a measure, and this is what we found when we looked at that measure compared to the spread. So again, in this picture, it's the same period on the horizontal axis. We're looking at the same spread, that's the blue line, but now I'm comparing that with this measure of risk that we came up with. This measure of risks looks at the difference between secured and unsecured loans between the banks. So the LIBOR loans, 3-month LIBOR loans are unsecured. There's no collateral of any kind. But there are other loans between banks that are secured, and these are called repurchase agreements, and they're secured by some kind of government bond. Effectively, you can think of it as collateral. So if you look at the difference between unsecured and secured loans, look at the difference between those rates, that would be a measure of risk. And if that was related to your LIBOR OAS, you might say, oh, that's jumped because of risk. Well, lo and behold, here's what you see. Obviously, there's a huge correlation between the two. They jump about the same time. There's some idiosyncrasies in both the markets, but the ups and downs are remarkably close. So this kind of evidence is what convinced me and Williams and some others, I think, that this was not a matter of liquidity, pure and simple. This was a matter of problems on the bank's balance sheets that banks understood and were reluctant to lend to each other, other things equal, and that caused this spread between the LIBOR and OAS. This is, as almost all the charts in this talk, there's lots of formal statistical analysis that underlies them, regressions and other measures of risk, other measures of bank lending rates. So this is, if you like, just the graphical representation of a lot more evidence. Okay, so that seems to me the right diagnosis. You got a problem, problems in the banks, try to fix the problem in the banks, maybe deal with those assets in some way, maybe start putting additional capital in the banks at that time, or at least maybe just being more transparent about what the problem was. And in fact, in September 2007, the CEO of Deutsche Bank said, why don't we all just be very clear about what's on our balance sheets and become transparent about that? And so far, we still have lots of misunderstanding about what's on those balance sheets, the so-called toxic assets. So the apparent conclusion of policymakers was not this, though. They argued it was a liquidity issue, and therefore responded by effectively providing liquidity. And I'll show you 3 examples of this, if you like, mistreatment of the problem. And just to be sure, there's always a question when you go back in time and re-examine decisions of policymakers. It's very easy to have the advantage of hindsight that they didn't have at the time. And I did policy, so I know that. So I just want to emphasize that this research I'm showing here was not done with hindsight. It was done at the same time. So it's very much available for anybody to take a look at. So just having said that, let me give 3 examples of the so-called mistreatment. One is this idea of providing more liquidity by making it much easier for banks to borrow from the Fed. Banks can always borrow from the Fed through the discount window. But in December of 2007, the Fed created a new facility called the term auction facility where banks could come through an auction and much more easily borrow from the Fed. And similar facilities were set up in Europe and Switzerland and a few other countries' central banks. So the green or red line shows this along with the LIBOR-OAS spread, that basic measure of tension in the markets. And it's a dual scale in this picture, so if you look carefully, you see on the right is billions of dollars. That's measuring the size of the extra liquidity that's being made available in the market through these term auction facility, sort of extra ability for banks to borrow from the Fed. And you can see that was 0 through December, and then it starts ratcheting up, and globally got to 200, and in the US, $150 billion. If you look at the blue line, it's hard to see any impact. The lines stay basically the same level. They tend to be drifting up. So it looks like this is not having the impact, and it would make sense that it wouldn't have impact if you believe this not to be a liquidity problem, but a risk problem. Again, like the other pictures, you want to look at statistics to prove this, and so there are regressions and other things to back this up, but that seems to me this picture is really worth 1,000 regressions, if you like, if not 1,000 words. And by the way, if you look carefully here, you can see some of the things that can fool people in real time. Just let me try to show this to you. If you look on the graph, there's a high level for this. LIBOR-ILS spread, December 07. And then it comes down. And it's coming down just about the time that the term auction facility is being put in place. So there were some policymakers who said, they obviously couldn't see beyond that period at the time, this is history, said, oh, the TAF is working. It's bringing down spreads. And unfortunately, that didn't last, and they started drifting up again. By the way, as so many things in economic analysis and history, you have to ask the question, could something else have been making things worse? And so to test whether the TAF was perhaps offsetting other things that made it worse, we included those other things in the regressions, and that could be these other measures of risk. So I don't think the argument that it would have been worse without this is correct, although you never know for sure. And that's the same true with the next example. This is another example, which is also the idea of providing more liquidity to people might get things going. It's not monetary policy per se, because it was not financed by money creation. It was financed by borrowing. But just about a year ago, in February of 2008, a stimulus package was proposed and passed through the Congress. And that was, again, to deal with this overall crisis and weakness in the economy. The major part of the stimulus package was to send one-time payments to individuals around the economy and do it as rapidly as possible. It was done mostly in May, June, and July of last year. And the US Treasury did a terrific job of getting it out fast, using direct deposits, notifying people in advance. Very impressive logistical operation. And therefore, you see a big blip in the overall income in the United States. So this chart here is showing, the sample period is January 07 to the middle of last year. And you see this big blip in personal disposable income. That's because of these checks being sent to people, pure and simple. In fact, you can take those checks out of the data and it's a flat line. The reason, of course, for this was to get people to spend more and increase consumption. And if you look at the picture, it really didn't do that. Didn't jumpstart the economy, didn't provide additional spending. And actually, economic theory would have predicted this. Maybe there'd be more of an increase in the picture, but economic theory, the permanent income hypothesis, predicts that there's a very small change from temporary changes in income like these checks. So instead of spending the money, people either put it in their savings accounts or drew down some of their debt. Not to say that either of those is bad, but it wasn't really effective in stimulating the economy. Again, this can be proved with lots of regression analysis, but this graph, I think, tells it all. In this case, you do have the same kind of possible debate that something else was dragging consumption down during the period that the rebate payments were made, and therefore those were effective. You just don't know what that was driving it down. So we tried things like oil price increases last spring and summer and various things. But I think ultimately you never know for sure that something else may have been involved. And to illustrate that, I tell you this little story that is true, unfortunately. A couple years ago, my wife bought me new golf clubs for my birthday. And it has one of these gigantic drivers. It's hard to miss the ball. So she said, great, it's going to be better. It's going to be more fun. That's just terrific. I'm going to go out there and it's going to be great. So this new golf set of clubs, I'm out there. And so a couple years go by, game is no better. I mean, it didn't do any good whatsoever. So I'm feeling kind of disappointed for me, and also, my wife, she bought me these clubs. What am I going to say? So I said, well, my game would have gotten a lot worse without these clubs, and I've maintained my own. So you can always do that, and that's it. Third example, which is I think more difficult to prove than the first two, but it's important to try to look at it anyway. The Fed cut interest rates very rapidly last spring, actually January, February, March of last year. And you can see that in this picture. This is the federal funds rate again, with the scale on the right-hand side going down from 5.25, which is where it was in the other picture I showed you, down to 2%. Now, there's no reason not to cut interest rates when the economy is going into a recession, which it later turned out to be the case. However, these were more rapid cuts, and I think more accelerated cuts, again, than a typical policy rule would suggest. So what would be the harm of overdoing it, if you like? And again, not to say that interest rates should have not been cut, but they shouldn't have been cut this much based on policy rule, historical types of evidence. Well, one thing it did, it probably made resets of mortgages a little less of a problem, but it also depreciated the dollar, I think. And because the oil is denominated in dollars, probably was a factor in this incredible rise in oil prices during this period. And you can see oil prices got to, well, these are monthly averages, goes up to just about 140. Closer measures daily, it got over, I guess, $148 per barrel. And so that was a huge increase just as we were going into this crisis. So this is the example where you could say the policy response may have actually made things worse. And I want to just be sure, this is probably this is one of the most difficult parts of this analysis to prove, but there are models that show that interest rates coming down rapidly will weaken a currency, other things equal, and that will affect commodity prices, including oil. So I think of this as a serious problem. Last spring, you may forget, last summer, those high gasoline prices and the extent that they affected purchases of vehicles, especially vehicles that consume a lot of gasoline, and they really hit the economy very hard. So those are my three examples. Now, let me move on. That was the second thing, what's made it last so long, okay? The third question is what happened last fall? What happened in the panic? Okay, well, first of all, here's a picture of the panic. This is amazing. Same measure of tension in the markets, LIBOR-OIS spread. And I also put it on the same graph, the difference between secured and unsecured loans. That's the red line, okay? So remember, the previous pictures I've been looking at only went through early September, August of 2008. Well, there you see what happened. And that was, we call this thing over here the black swan, because it was so large and unusual. And then you come over here and you see something 4 times as big. It was incredible. And this is really the panic. The stock market fell very rapidly during this period. And of course, the problems in the banks as represented by the secured, unsecured lending rate and LIBOR-OIS got very high. They reached a peak on October 10th of 2008 and then came down for reasons which I'll try to explain in a minute. Okay, so this is the worst. This is a terrible worsening. Stock markets fall. This is a global phenomenon. Employment, consumption starts declining. Stock markets dropping. And see, this is really what you could call the panic of 2008. So what happened? What caused this? And sometimes people think of this as that last part as the financial crisis. Remember, it goes back a long ways. It's lasted through this period, still with us. But this period, this worsening is very important to try to understand. There's some conventional wisdom out there about why this happened. And the most famous one is the failure of our government to bail out Lehman Brothers. And that occurred, that decision was made over the weekend of September 13th and 14th, and it became clear to people on the Monday the 15th of September. All hell broke loose around that time. So is that a good explanation or not? Well, I don't think it's certainly obvious that's the answer, even though that's the conventional wisdom right now. So I want to try to look at that by looking at an event study during this period. Okay, so what I'm doing now is taking that same measure of tension in the markets, LIBOR-OIS, narrowing down, focusing down on the period around the Lehman Brothers bankruptcy, looking from September 1 through mid-November. And so that's just to go back, that's the blown up version of that spike on the right, spread out, so you can look more carefully at the numbers. These are daily numbers. You're coming into mid-September, and the LIBOR-OIS spread is still elevated quite a bit from where it was before the crisis began in August of 2007. So you see it's maybe creeping up a little bit, but it's around 1%. And then you have the Lehman Brothers bankruptcy because there was no government support provided over that weekend. And you see a blip in that rate. No question it comes up. It comes down the next day. That's when AIG was intervened, rescued. And then it starts to creep up a little bit. And then on the Friday the 19th of September, the Treasury announces it's going to have a new package to deal with this problem. And that was the so-called TARP program. So far, not really anything that would say the spike happened on September 15th, for example. However, over the weekend of the 20th and 21st of September, the TARP was fleshed out to some extent, and by the end of the weekend, ready to be presented by the judgment of the Treasury and I think the Fed. And on Tuesday the 23rd, the chairman of the Fed and the secretary of the Treasury testified in the Senate Banking Committee about their proposal. Okay, their proposal had 2.5 pages of proposed legislation and asked for $700 billion. The senators on the panel asked a lot of tough questions. I don't know if sometime you might want to go back and look at the YouTube of part of that hearing. Very tough questions, as you'd expect for a sudden request for $700 billion or 2.5 pages of legislation. There was no mention of what the oversight would be, very little description of how the money would be used. The best description is they were going to use the money to buy the assets, troubled assets at the banks. That's the reason for the name, Troubled Asset Recovery Program, TARP, TARP. I don't think the response was very good. The answers to the senators' questions demonstrated that maybe this had not been thought through that much, just sort of sometimes conflicting testimony. The mail many senators received at this time was, like they say, the most irate they'd ever got. Their constituents really quite angry about the whole thing. And then over the next few days, like I say one more thing, the testimony itself and the coverage of the testimony made it clear not only that this whole response policy to the crisis had not been fully worked out, but also reminded people how terrible the situation was, because to make this sell, you really had to talk down the economy. Really, you could say it was using a tactic of scaring, or at least making the situation look very bad, and I think that was a factor. In any case, who knows exactly? The timing is such that things really got bad then, 10 days after Lehman Brothers itself. And to me, this is really kind of a more convincing reason. We'll never know, let's face it. This is something we're going to be trying to understand for years. But it's very important to try to work this through. I think the way to link this to Lehman Brothers, I would say, is the following. It wasn't so much saying no to Lehman Brothers. It was the whole process of lack of clarity of how it was done. The first major intervention in a private financial institution in this crisis was back in the spring of 2008. And that was with respect to Bear Stearns. And Bear Stearns was rescued. There was loans made to J.P. Morgan, which were then worked with respect to Bear Stearns. The Fed took some of Bear Stearns' portfolio, still is owning some of it actually, and that was quite a surprise to people at the time. But it was done, and the rationale was asked for, if you like, and quite frankly, I don't think a good rationale was given, at least in the sense of when would we do this again? What were the reasons we did this with Bear Stearns, and we might not do it for a Lehman Brothers in the future? What were at least some guidelines so that the people in the markets can figure out what the government is going to do? Some element of predictability. It is possible. Predictability is a huge advantage in terms of making policy good and effective. So there just wasn't really much of that. And then when Lehman Brothers hit, even though the Treasury Secretary said no in advance, there's no funds, many people thought that couldn't possibly be true. They came in and rescued Bear Stearns. Why wouldn't they do it with Lehman Brothers? So when they actually did say no, it was quite a shock and quite a surprise. The TARP announcement itself, if you, I think, clarified the extent to which there was not a coherent strategy for dealing with these institutions. And it demonstrated that. I mean, weeks later, I should say, the surveys of experts in the financial markets said they didn't understand how the TARP was going to work. And maybe the final piece of evidence in this puzzle is to say, well, what happened on October 13th, Monday, that got things moving in the other direction? Well, that was the day that they said, we're not going to do what we said we were going to do in the testimony, which was to buy up the toxic assets. Instead, we're going to push equity into the banks, and that's going to be more effective. And that certainly turned things around. And maybe there were other things, but that certainly has the timing right. And I think here it's not so much that was clearly going to be more effective, because you can question that now, but the fact that there was now a strategy put out of what we're going to do with this $700 billion. It wasn't what they said originally, with somewhat demonstration about the uncertainty, but at least it was something. It was some clarity, and I think the response of that was what you saw. Okay, so to wrap up my what went wrong, the worsening seems to me to be this unpredictable, not very clear response to the financial institutions themselves. Now, I think, John, I'd maybe take 5 more minutes and wrap up. I really disappointed about this as a person interested in policy and someone who's worked on this for so long, because I don't think it had to be this way. Sometimes I cry when I think about this. And one way to think about it is, and I do this in my book, is to remind yourself that there were periods not so long ago where more predictable policies, more keeping on track, made a huge difference. And here's my example of this. This is a chart of real GDP growth on a quarterly level going back to the late 1940s and going through the present, basically. And so you can see lots of ups and downs in the economy, recessions and booms, recessions where economic growth goes down below the red line, which represents 0, so it's negative growth, and there's a lot of ups and downs. That's if you like, the turbulence that occurred. It was true of the economy quite a bit, especially in the 70s, but generally through this period. Then, in the early 1980s, there's this amazing reduction in the volatility. Economists call that the Great Moderation. I think, based on research, that you can show that that was about when policymakers, especially monetary policymakers, with Paul Volcker getting things started, took the inflation rate down, developed a coherent response mechanism. That response mechanism is that interest rate formula approximately described by, not that it was that policy rule was being followed literally, but was a good description, and we got this amazing degree of stability. So you did move from a bad situation in the 70s to a much better situation because of the more predictable policies. And it was really only recently, in the early part of this century, 2002, 2004, in that period where policy got off track, and I think that's why we got here. And then that coupled with the additional things that I mentioned is why the whole situation we're in is so bad. Different viewpoint. You don't hear it too often, but I'm more and more convinced that there's, whether you debate certain parts of this or you say, well, that's not quite right, or you have more evidence, I think basically this message is going to be what survives debates which will be going on for many, many years. It might not be exactly my story. We're still in the crisis. I don't have 30 years of perspective like Friedman and Schwartz had. Somebody will have that in the future. But right now, it seems to me that my guess is this general explanation will last, even though it's still a very small number of people out there. Think of it this way. It seems to me this is the way we're going. A brief word about what has happened since November. We've had an election. We have a new president. We have new proposals. It seems to me, unfortunately, that the things I'm pointing out here went wrong, especially in the last year of in 2008, late 2007, are continuing. We have another stimulus package. The stimulus package has a big component of temporary tax rebates in it. Look what happened the last time we did this, just 1 year ago. There's a attempt to have more government spending now in the stimulus package that passed this February, February 09, but it doesn't occur now when we need it. It's spread out over time. So it seems to me the same kind of problem is there. If you look at the response in the banking sector proposals, they seem to have the same element of not a lot of clarity about what the proposals are. And I think you listen to the markets during this period, you see that. So unfortunately, and this is a nonpartisan analysis. I'm criticizing Republican administration, and now I'm criticizing the start of a Democratic administration. It seems the same things that we're seeing, and it worries me. And I think to some extent, if there was one message from this research, it's that at least try to consider the possibility that these government actions and interventions could be making things worse. Think carefully about just saying the government is the only answer to our problems, which is where we seem to be going now. Think about that carefully before we continue. So let me stop there and see if there's any questions. Thank you. We'll open up for questions. Start again. Right here.
Can you talk about liquidity and how much we should provide for the financial institutions, and also what point are we providing so much that we're overexposing ourselves to the risk of hyperinflation long term? And where's the point where you say enough?
Yeah, one of the big things that's happened since the panic, if you like, is that the Federal Reserve has increased base money by a huge amount. Through the first year of the crisis, when they provided loans, say through the term auction facility, the TAF, they sterilized those by selling off government securities. But starting in September, they stopped, and therefore reserves at banks, which is a big component of base money, have skyrocketed. And so I think your question is that the right thing to do with monetary policy? Well, two things. Once, when they increased those reserves so rapidly, it drove the interest rate down to zero. The FOMC eventually ratified those decisions, but it drove the interest rate down to zero, which maybe they want to do anyway. So then when it got to zero, of course, they have to figure out what to do because they don't have an interest rate to reduce any further. So what this is now sometimes called is quantitative easing, because the emphasis is on quantities like money or reserves rather than on the interest rate. To me, the main reason why base money has increased so much is not because of quantitative easing per se, the fact that they want to increase reserves because interest rate's at zero, but because they're using those reserves to finance the purchases of the securities. In other words, if the Federal Reserve is going to buy mortgage-backed securities, it's going to make loans to AIG, if it's going to provide funds to the commercial paper market, and consumer market, business market, which they're doing, then they have to finance it some way. And the easiest way to finance it is by creating money, and they're creating money effectively by crediting banks with deposits on the Fed. That's the monetary base is part of that. So it's skyrocketed. It's increased by a tremendous amount. From September to December, reserves at the Fed by banks increased by 100-fold, from 8 billion to 850 billion, just an incredible rise. So that's all this money out there that could cause inflation. And so people are worried about it, I'm a little worried about it, but the Fed obviously knows about this. They look at it very carefully, and the chairman has said we'll be able to bring this out when things improve, we'll be able to remove those funds. But you have to say, well, to do that, you'll have to sell mortgage-backed securities. That may drive up mortgage rates. Are you going to be able to do that? So that's kind of the thing you can worry about when you try to say, is this the right thing to do? The other thing about it, which is very unusual for central banks, is to purchase so many private assets in certain markets or certain firms. Generally, central banks have bought government securities. It's kind of a neutral way to intervene and increase the money supply or decrease it when it's appropriate. So this is really uncharted territories, investing in certain sectors, certain firms, and financing it with money creation. And I'd say it seems to me the best thing is to be as transparent about it, explain what's happening. For a while, the Fed didn't explain it very well. They've just a week ago, yesterday, they introduced a new web page to describe all these actions, describes their balance sheet. It seems to me that's good. More transparency is a good thing to be doing. But we still should be very careful, and I think generally worried that all that money could come back and then cause inflation. Hopefully they'll be able to control it. And then one last thing about this that I mentioned, buying certain types of securities, mortgages, student loan securities, et cetera, does raise the possibility that that's what central banks, our Fed, will do in the future in normal times. And I think that would be a real mistake. If in normal times you buy certain mortgage-backed securities or consumer loans to help that sector, you're not doing central banking anymore. So you got to be on guard for that too. And you don't know who's going to be running central banks in the future. There's not infinite terms. So it's something to be watching for. Yeah. Oh, sorry. Are you calling on people? Okay.
Why don't you go ahead?
Okay. Okay.
Based on what you said, I haven't heard a lot about the solutions, given that if it's the risk that was the real problem, what solutions you would talk about. And even during these periods of moderation that you're talking about, there are still recessions. Do you see any role for government besides central banking to help out during these recessions?
Oh, absolutely. First of all, you do have central bank, which is a huge part of it, and responding predictably in a way that people understand did make a huge difference. By the way, I don't think you can repeal the business cycle. I think that's not going to happen. But you can make it small, and like it was for a good couple of decades, make it long expansions, short recessions. That's possible. But to eliminate them completely, I think, is not possible. That's monetary policy. With respect to fiscal policy, yes, I think, first of all, you do have these automatic stabilizers, which means that when the economy goes into a downturn, the tax revenues decline and spending automatically rises, so that causes a deficit, which is you don't want to prevent. You don't want to raise taxes in a recession to keep the budget deficit from rising. So that's one example. You have a good fiscal policy that's designed to move with the cycle, if you like. So deficits increase in recessions, and then you get surpluses in booms. I know it's hard to imagine. So I think that's what I would argue for, and absolutely there's a role for government. And I just don't, with respect to the title of the book, I just don't want people to think that government always gets it right, because there is government failure. It's possible to get government failure, and sometimes it is the right thing is to say no, or to have a smaller package, or to think about the ramifications of changing too many times and how that can confuse people. So those are really serious worries about the way government takes a role.
One thing I expected you to say more about in this talk was the mispricing of risk, the fact that the toxic assets bundled in with good assets given a AAA rating. Do you think there was anything policymakers could have done about that earlier? Do you think that's an important part of it?
Yeah, I think there's some accountability issues that could have been done better. Accountability of the rating firms, where they were getting their fees from, for example, was not what you'd think would be the best. The lack of accountability of the originators able to sell mortgages off and then have the investors worry about it. I think that's certainly going to learn from that. Right now, it seems to me that there's still a transparency problem about those original mortgages. The investors frequently don't know which of those mortgages were issued that the borrower certainly was creditworthy and ones which were very questionable. So I think maybe even some requirements for more transparency would be useful to deal with that. So yeah, no, I think that was a part of it. I do think that some of that mispricing, just to go back to my general theme, could have been induced by the very low interest rates. You have low 1% interest rates, say, you're looking for a little extra yield, the 10 basis points, 20 basis points looks attractive when interest rates are at 1. So you may take on too much, willing to take on too much risk and listen to a rating agency that you maybe wouldn't want to listen to. I mean, it's amazing to me how much people paid attention to those rating agencies. Sometimes government required that they pay attention to them. But it definitely is a problem and to some extent related to the low interest rate itself.
When you say you don't like the way things are going, how much worse do you think things will get? And considering these expectations, what do you recommend for someone like myself who wants to get a job in a financial area but is very much demoralized by the almost impossible job search?
Yeah. The financial industry is not the best thing to be going into these days, but how about teaching? It's a pretty important job. No, I think there's obviously kind of a downsizing going on in the financial industry, but there's always good jobs for people that are ambitious and look around for them. So I wouldn't feel pessimistic about it. It's tough. It's going to be tough for a while. But I think, I actually have my talk probably sounds pessimistic, but I have very favorable long-term view of the U.S. economy and the world economy. It's, again, part of it is contingent on we don't move away from what I think were very successful policies in the 80s and 90s, opening markets, the end of central planning for all intents and purposes, millions and millions of people brought out of poverty. So with this heavy emphasis now on government interventions, and I worry a little bit about that, we could have more protectionism. So assuming that we don't really get off track even further, I've got to be optimistic about the future. So I would think long term, there's maybe the opportunity cost is you stay in school a little longer. That's what we suggest. But think long term, be positive. Be positive. We're going to get over this, and a lot of people are interested, and you got good minds working on it. So be positive about it.
You spoke a little bit about the Obama stimulus package. Could you discuss that a little bit more? If there are any good parts, what are the worst parts, and if you could do it yourself, what would you have done instead?
Well, on the last part of the question, I would have done three things. One, right away, make the middle class tax cut that he proposed permanent, which was right now it's temporary. It's part of the package, but you only get these payments temporarily. So make that permanent. That's what he campaigned on, and it's fine. Make it permanent. That's what I suggested earlier in the last fall. I would also say that there shouldn't be any tax increases for 5 years, 6 years, whatever you think is right, because I think those tax increases will be harmful. Higher taxes on dividends, capital gains can't help these markets, and even higher taxes on the two top rates, which are a lot of small businesses pay those rates. Those seem to me not the things to be doing at a time like this. So I'll pledge, if you'd like to keep interest rates, tax rates constant is what I would have done. It's not where we are right now. And then with respect to the size of the package, I would have emphasized the automatic stabilizers a little more, that you're getting an automatic stimulus. The deficit has got up to 1.25 billion just because of the weak economy, 1.25 trillion just because of the weak economy. So we've added to that, but that was stimulus already. And I think the fourth thing, infrastructure spending does stimulate. You know, you build a road, you got to hire the workers, and so that's fine. Unfortunately, this package has very little infrastructure spending in it compared to the total package. And this year, in 2009, there is 21 billion in federal purchases of goods and services, $21 billion out of a $787 billion package. So it's not enough, and that's the problems with as well as some of the proposals that I would have done instead.
Yeah, I was just wondering, in Geithner's last speech to the public, he kind of talked about, it seemed like a joint venture between the private and public sector to try and buy some of the troubled assets from banks. And I was just wondering if you had any idea of how they're going to be able to kind of close the gap between the bid-ask on these assets were, very almost impossible to value. Like, how are they going to be able to bridge that gap to finally get these things off the bank's balance sheet?
I don't understand enough about the private-public partnership proposal to. I'd say that's one of the examples where we really like more clarity about it. But to answer your question specifically, I think more transparency is the way to do it. There's question. Why is there a difference between bid-ask spread on these derivatives? Because people don't know the value, right? There's different guesses about the value. And one of the reasons for the uncertainty is the complexity of the instrument, the different tiers and levels. But another reason is the underlying mortgages themselves, the underlying assets themselves, where, as I mentioned before, there's still a lot of questions about what the terms of those mortgages were. If you talk to people in Wall Street now who are holding those securities, the investors, they would love to find out more information about the mortgages, the mortgages themselves, but the servicers just generally don't provide that information. So I think that could help a lot. More transparency about the mortgages and the instruments themselves, I think, could help a lot. It's very complex. It would have been better to start on a lot earlier, but it still seems to me that's something like that has to happen because you can't clear a market where there's such big uncertainty about the value of the instruments. Mario.
I think the interest rate declines are pretty compelling in terms of the lending boom. But, there's a lending channel there between monetary policy and the area economy you didn't talk that much about. But if you think of banks as following rules, consensus seems to be they follow more liberal rules over this period than historically.
Yeah.
Do you view that as a multiplier of the monetary policy mistakes or a separate causal channel?
I think of it as a multiplier rather than a separate cause, and partly because I don't think that's changed very much, unless it's related to the search for yield a little bit. I don't know if it would be, but it seems to me it amplifies rather than a separate cause right now.
And should that factor into the monetary policy rule?
Yeah, all right.
So if we're looking at the pre-moderation period, maybe we could say that was influenced a lot by Keynesian ideas, and then maybe the moderation period influenced a lot by Friedman, and maybe we're looking at sort of a redux of Keynesian economics. Do you see any flaws with the whole looking at output of in terms of spending, C plus I plus G, and all of that? Is that a flaw?
Okay, a couple of things. I see no flaw with looking at output as C plus I plus G plus net exports. It's an accounting identity. I love it. I always use it. One thing we can be certain about in economics is accounting identities. So use them whenever you can. So that's a good one. But that's not, I think, a representation of Keynesian economics. It's just, it's just a way to think about GDP and measuring it. So the question about Keynesian versus Friedman or other approaches, I'll say a couple of things. I do think I do think the 1980s and 90s, the Great Moderation, was because of a firm commitment to bring inflation down and not be so concerned by the inflation-unemployment trade-off, which had Keynesian origins, if you like. So I think that was a movement against Keynesian, which was very important to do. There was, as Milton Friedman argued, there was no long-term trade-off between inflation and unemployment. Paul Volcker came in and somehow implemented that and got inflation down, and there was a tough adjustment, but then generally things worked better, and then Greenspan did very well in terms of keeping that inflation rate stable, roughly stable for a long time. So what I've observed, and it's a very interesting question, is more recently there's been this more interventionist, more stimulus packages and more things that didn't seem to be as common in the Great Moderation period, certainly with respect to monetary policy, but also stimulus packages. And I don't really, it's definitely a movement back, there's no question about it. I did a paper a month or so ago that I tried to look for the empirical rationale for that movement to a Keynesian economic. Did we get some good results from Keynesian policies? No, I didn't see any. What about policies in Japan, which used a lot of fiscal, they didn't seem to do anything. You had this rebate picture I just showed you. So in my perspective, I don't see evidence bringing that change. Some people say that this is such a severe crisis that you have to bring these Keynesian-type policies back into play. This is the interest rates at zero. You have to do this kind of thing. But it seems to me that's not an explanation, because we had a stimulus package in February of last year when the interest rate was well above zero, when it was not yet as severe a crisis as occurred later last year. And we did the same thing. So it seems to me you need to have other explanations. I don't fully have an explanation of why we seem to move away from policies that really, why we got off track, put it that way.
Is there any other question? Back there, and then we'll stop after that.
I guess beyond the financial crisis, what policy recommendations do you have, both fiscal and monetary, to prevent something like Japan's lost decade? And to what extent do you feel like we're moving in that direction?
Well, longer run, I think bringing the budget deficit, into line, worrying about other sources of imbalances in the federal government, Social Security, the health programs, Medicare, Medicaid, healthcare explosions. There's huge projections of unfunded liabilities. Those are really serious down the road. So I think it's really, I would really like to see now a proposal to at least establish a committee to deal with the Social Security insolvency and get that behind us. It's not that hard a problem to solve, and it's really good for the future, and it would help demonstrate that government can really do something. It's obvious, everybody agrees you got to do something about. I think that those are probably the most important things. Right now we've got a budget proposal for the next 10 years that has deficits, unbelievable deficits. The debt was going to double in the next 4 years, debt held by the public. And then there are deficits of $500, $600, $700 billion a year out 10 years. The deficits projected for 2018 is still $700 billion. So it's not converging. It's not converging to balance in any way. So those are the things I would want to address. But you got health care for the private sector that needs to be worked at, and that's going to help reduce the government spending as well. So there's a lot of things to work on. Actually, one thing that, if there's a little silver lining here. We've had a very low saving rate in the United States for a while, and that's caused a trade deficit and current account imbalance, and savings rates are moving up. I mean, that's part of the collapse of consumption, but that's good. We're going to have higher savings rates in the future. So if we get to that mode where Americans are saving more, I think that would be good for the world economy and good for balances. I hope we continue in that direction.
Okay, last question.
So it looks to me like the credit crisis in least, began in August of '07 with a sudden, dramatic, a black swan event. Why so sudden? Why was it not foreseen? What happened to call that tremendous, at the time, spike all at once?
I don't know why it happened exactly at that point. Obviously, there was recognition about the balance sheet. Something made secured, unsecured lending spreads jump. It's, sometimes things occur because somebody finds out and the information becomes very clear. I cannot say why it occurred on August 9th and 10th. I have no idea, anything special. There was, if you look back from that vantage point, you see various things you can point to that would make this happen, but you can't, I don't know anybody who's tried to say why it happened on August 9th and 10th. I just don't know. Maybe we'll find out sometime, but I don't know.
Okay. Before we conclude, there's a reception following the lecture on the 4th floor of Calhoun. Anybody's welcome to come talk further with Professor Taylor. And as I mentioned earlier, 2 of his recent books, the one on global financial warriors, where you can see how life as an economist can be exciting, and the latest book related to this, Getting Off Track. They're both available here, and John will stay for a few minutes if anybody wants a book to be signed. So it's been great, and we really appreciate John giving this talk today.
Thank you a lot.